All right, let's get right into it. If you're an American investor in the tech space, you know the trade desk has been a total market darling for years. But wow, in early August 2025, something just went completely off the rails. So, in this explainer, we're going to break down the anatomy of this collapse and figure out what on earth caused this star company to suddenly fall off a cliff. This right here, this is the number that absolutely shocked Wall Street. Right after their second quarter earnings report, shares of the trade desk just cratered. We're talking down nearly 40%. And look, this wasn't some minor dip. This was a move that vaporized about $15 billion in market value, practically overnight.
You know, on social media, investors had a name for it, a falling knife. It's that feeling, when a stock is in total free fall and you have no idea where the bottom is. It perfectly captures that sudden, sharp shift in feeling around a company that honestly seemed unstoppable until that very moment.
So, that leads us to the big question, right? What in the world just happened here? I mean, how does a company go from being a Wall Street favorite to a falling knife so fast? To really get the collapse, we first have to get the company. So before we dig into the crisis, let's just do a quick reset on what the trade desk actually does. Their whole business, their whole philosophy, is built around a really specific vision for how digital advertising should work. At its heart, the trade desk runs something called a demand-side platform, or a DSP. I know, it's a super jargony term, but just think of it like this. They give advertisers the software, the tools to buy digital ads automatically across millions of different websites, apps, and streaming TV services. And this is where things get interesting. This is their battlefield. See, the trade desk, they fight for what they call the open internet. That's the huge, sprawling world of independent websites and streaming platforms. This puts them in a head-to-head fight with the walled gardens. You know who I'm talking about. Google, Meta, Amazon, the giants who lock up their user data and ad platforms. And this distinction, it is absolutely critical for understanding the pressure they're feeling right now. Okay, so with all that background, let's get to the main event. The stock didn't collapse because of one single thing. No, it was more like a perfect storm of three different problems that all decided to show up at the exact same party. It was really a cascade, like a domino effect. It all kicked off with their own financial forecast, which was then made worse by a pretty stark warning from their CEO. And finally, it was all cemented by this growing fear about a massive competitor. Let's peel back each layer. First up, the guidance. And this is the part that really threw the market for a loop. The crazy thing is, the trade desk reported great results for the second quarter. They beat expectations. But as you know, Wall Street doesn't care about the past, it's all about the future. And their guidance for the next quarter came in a little light, below what analysts were hoping for. And for a high-flying growth stock like this, even a tiny hint that the growth engine is slowing down, well, it can be absolutely devastating. So you're probably asking, why the weaker guidance? Well, on the earnings call, the CEO, Jeff Green, he gave a very specific reason. He pointed to the potential impact of tariffs from large brands. He was basically signaling that a potential trade war could make big advertisers get nervous and slash their ad budgets. And that, right there, injected a huge dose of real-world economic uncertainty into the company's future. And that guidance miss, it landed at the exact same time another huge fear was bubbling up to the surface. And that's the elephant in the room, Amazon. So while investors were trying to process the tariff warning, they were also starting to panic that Amazon's own ad platform, with its enormous closed-off ecosystem, was becoming a legitimate threat to the trade desk's entire business model. And that fear of competition suddenly felt very, very real. At the same time, reports started swirling that a super important partnership they had with Walmart, Amazon's biggest rival, was up for renegotiation. All that uncertainty just poured fuel on the fire, that Amazon was starting to squeeze them and maybe even poach their biggest clients. So there you have it. That's the story of the collapse, a perfect storm of slowing growth, economic anxiety, and the threat of competition. But the real question for any investor looking at this now is, where does it go from here? This huge drop has created two totally different arguments about the company's future. So you're at a crossroads. The bears, they're going to tell you growth is slowing down for real, that Amazon is a monster they can't beat, and that a recession could crush ad spending. But then you've got the bulls. They see a completely different picture. They're saying, hold on, this company is a leader in the hottest parts of advertising, connected TV, and AI. They'll point out that the stock is now priced at levels we haven't seen since 2018, and that the core business is still a cash machine with incredible 80% gross margins. So, with two really strong arguments, what should an investor actually be looking for? Well, instead of making a prediction, let's wrap this up with a clear checklist of the signals that are going to tell us where the trade desk is really headed. Okay, here it is, your monitoring checklist. Number 1, the Q3 earnings report in November is everything. Did they hit their lowered target? Number 2, we need to hear official news on that Walmart deal, one way or another. That'll be a massive signal. 3, keep your eyes glued to their connected TV growth. That's their main engine. And finally, just watch the broader economy. News on tariffs, consumer spending, it all flows downhill to ad budgets. You know, it all comes down to this one last question that every single investor is asking themselves right now. Was this 40% collapse just a brutal, temporary storm for a fantastic company, maybe even creating a huge buying opportunity? Or is this the start of a whole new chapter of slower growth for the trade desk? Honestly, only time and watching those key signals we just talked about is going to give us the answer. If you found this breakdown helpful, please subscribe.